Why Tesco failed in America. Imagine a massive retail company spending 3 full years researching American shopping habits before finally launching a new store format they believed would change the way Americans shop for groceries. This is Tesco, one of the largest retailers from the UK, with their new product called Fresh and Easy. Even with such deep research and such a massive investment poured into the process, this venture ultimately ended in losses well past $1 billion and the closure of every single store within less than a decade. In this video, we're breaking down how even the deepest research turned out not to be enough to save an expansion strategy that ultimately failed to adapt to the real market reality. In November 2007, Tesco, the UK-based retail company, officially entered the US market by launching a new small format grocery chain called Fresh and Easy. Interestingly, Tesco didn't rush into this market. They spent roughly 3 full years researching American shoppers' habits before actually launching this new store format. This sounds like an extremely careful, well-calculated approach, something that should have minimized the risk of failure. But as we'll see throughout this video, even deep research turns out not to guarantee success if the strategy's execution afterward isn't genuinely adapted to the real market conditions being faced. Tesco set up its American headquarters in El Segundo, California. Terry Leahy, Tesco's CEO at the time, became a strong champion of this new store format. He described the convenience concept, small-scale, quick grocery shopping, as the fastest-growing sector of retailing around the world. Based on this belief, he bet that the American market was ripe and ready for the same business model that had already proven successful in the UK market. This was fairly significant optimism from the company's top leadership. But as often happens in cases of international expansion, the belief that a model successful in one market will automatically succeed in another often turns out to be a dangerous assumption if it isn't carefully tested. Tesco believed they had discovered a secret that no competitor in America had cracked: a cold chain delivery system that was already fairly popular and proven successful in the UK. They assumed this system would give Fresh and Easy a significant edge: fresher products and a far more efficient distribution system compared to existing American competitors. This sounds like an extremely strong competitive advantage on paper, but this assumption was based on one fundamental mistake: assuming that a system successful in one geographic context would automatically work just as effectively in a very different geographic context, something that would quickly prove to be a major problem. This same cold chain system quickly failed when applied in America. The reason is fairly fundamental. The United States' far larger geographic scale, combined with a much lower population density compared to the UK, made this system's logistics far less efficient than expected. Picture this fundamental difference. The UK is a country with a relatively compact territory and high population density, allowing a cold chain distribution system to operate extremely efficiently over relatively short distances. The United States, on the other hand, has an enormous territory with a much more spread out population density, especially across many of the regions Fresh and Easy was targeting for expansion. This is a perfect example of a secret or competitive advantage that was actually heavily dependent on the specific geographic context in which it was developed, something that can't simply be transplanted into a very different geographic context without massive adjustments. Another fairly significant problem involved the store format itself. American consumers, already accustomed to large one-stop shop supermarkets where they could get nearly everything they needed in a single visit, found these small, Fresh and Easy stores fairly confusing and limited. The root of the problem is fairly clear. Tesco largely exported its British business model wholesale instead of genuinely adapting it to local American shopping habits. British consumers were indeed more accustomed to small store formats scattered across various corners of the city, given urbanization patterns and shopping habits that differ from those in America. But expecting American consumers to immediately adapt to a store format so different from what they were used to, without meaningful adjustment, created fairly significant friction right from the launch. Tesco then compounded this problem with two additional, fairly significant mistakes. First, they set prices too high for price-sensitive American shoppers. This created a gap between consumers' price expectations and what they actually found at Fresh and Easy stores. Second, they opened too many stores too fast before genuinely validating whether this business model could succeed in the American market. This pace of expansion eventually saddled them with excess inventory they couldn't sell through. Picture this combination: stores struggling to find their identity in a new market, plus uncompetitive pricing, plus excess stock continuing to pile up, a combination of problems that kept reinforcing each other. In April 2009, Tesco finally admitted that Fresh and Easy was posting a trading loss of £142 million. This is an extremely significant figure, showing the scale of problems that had already been piling up since the initial launch. Even though they tried temporarily closing some underperforming stores, this effort turned out not to be enough to turn things around. Sales never meaningfully recovered after this point, signaling that the problems Fresh and Easy faced were far more structural and deep-rooted than just a short-term operational issue that could be fixed by temporarily closing stores. Some critics tried tracing this failure's roots further back, with a fairly interesting argument. London's financial sector had reportedly pressured Tesco into pushing into the US, with the goal of boosting the company's valuation, rather than this move stemming from genuine retail conviction about the American market's potential. This is a fairly heavy accusation, as it implies this major expansion decision may have been driven more by financial market pressure than by genuinely solid business analysis from Tesco's own internal retail team. Interestingly, Tesco's own leadership under CEO Philip Clark, who took over after Terry Leahy, reportedly never seemed fully convinced that Fresh and Easy could work. This skepticism from the company's own top leadership was then increasingly shared by investors, who began losing confidence in the business's long-term prospects. In April 2013, Tesco finally confirmed it was exiting the U.S. market entirely. They recorded a write-down of £1.2 billion, a figure so massive it helped drag the company's full-year net profit down by 96%, leaving just £120 million. Just imagine the scale of this financial impact on Tesco's overall global business. A failed expansion project in one particular market ended up having such a large impact that it nearly wiped out the company's entire annual profitability. By December 2012, before this exit decision was officially announced, Fresh and Easy had actually grown to more than 200 stores spread across Arizona, California, and Nevada. This scale shows that even though problems had started becoming visible since 2009, expansion continued for several more years before the exit decision was finally made. In September 2013, Tesco sold the entire Fresh and Easy business to Yucaipa Companies and officially exited this market completely by November of that same year. But this story wasn't entirely over yet. Even under new ownership, this long, struggling chain never truly found stable footing. The business eventually filed for Chapter 11 bankruptcy, and all remaining stores closed for good in November 2015, capping off a chapter that had lasted nearly a full decade, with Tesco's total U.S. losses running well past $1 billion. So what's the big lesson we can take from Tesco's failure in America? Even deep market research, even research that took 3 full years, turns out not to be enough to guarantee success if the strategy's execution afterward isn't genuinely adapted to the geographic realities, consumer habits, and price sensitivities of the market you're actually trying to enter. Tesco made a fairly classic mistake in international expansion. They assumed that a secret or competitive advantage that worked in their home market, their cold chain delivery system, would automatically work just as well in a very different geographic context. They also exported their store format wholesale without genuinely adapting it to American consumers' shopping habits built up over decades. This story also raises a deeper question about corporate governance. Was this major expansion decision genuinely based on solid business conviction? Or was it actually driven by external pressure to boost the company's valuation in investors' eyes? When internal leadership itself isn't fully convinced by the strategy being pursued, that's a warning sign that shouldn't be ignored. If you enjoy global retail business case studies like this, Don't forget to like and subscribe so you don't miss other case studies on global business successes and failures. See you in the next video.